Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. The S&P 500 has been pretty much doing nothing for the past few weeks. Ever since the month of September, 26th of September, here we've been pretty much flat. Now, of course, we've had some massive swings up and down, but no real direction on the stock market. Now, a lot of people say that this looks like a coiling pattern, a consolidation pattern before the next move down, before we basically get a continuation of this move and we get another 10-15% move down, potentially down to 3,000 points. Many people are currently expecting this kind of move, and it's not completely crazy, right? Especially when you take into account the fact that the 100-week and 150-week moving average were both broken in this correction, and the 200-week moving average is barely holding, right? If this gets broken, you really lose that last secular bull run structure that's been holding things together ever since 2009, and you do start to look a lot more like what happened here, which obviously led to very, very poor market performance. Now, should we expect this moving average to be broken and actually get a more meaningful drop down potentially to 3,000 points? We're going to talk about that in just a second. I'm going to show you some very, very interesting charts that are hopefully going to make my point very clear. But before we get into what I think, because this is why we do these videos, to give our opinion, I think it's very important that we have this debate, that we have these discussions, so that people on YouTube, people on the internet can take in all of these views and make up an opinion for themselves and be better informed individuals. So before I show you what I think, let's take a look at the flip side of the coin. I think that's very important to do every once in a while. So if you're bearish here, you're really looking at this as an example, right? As you have a type of classic correction down to long-term moving averages, a lot of people are starting to look for a low at around the 200-week moving average. It gets broken and you almost immediately have a panic move down, a waterfall sell-off down, with the VIX spiking to around 46. And we've talked about that a few times. Here, yes, we've had the VIX spike up to around 30, but we haven't had a real spike to around 45, 46, which is what you can often get during real big capitulation events like 2011, like 2008, 2020. Let's go back a bit further. These capitulation events in 2001, 2002 also saw the VIX above 40. We haven't seen that yet, right? That's a big part of the bearish case. It's people saying, okay, we've had this kind of controlled downtrend down to the 200-week moving average, but the worst is yet to come. Earnings are going to move down, and you're going to see a pretty violent move down in the market, retracing probably a big part of the move up we had throughout this period, similar to 2008 and 2000. If we take a look at the breadth, right, this is what the bearish case is. The bearish case is that in each of these cases, you had the Fed step in and kind of prop up the market as you had these oversold readings on the breadth. Every time, right, stimulus, pivot, I believe Yellen said something very dovish back in 2016 as well. And yet here, we have this oversold reading, but we don't have a Fed pivot just yet. So a lot of people are saying, until you get the Fed pivot, why would you expect this type of move? Which is what you saw in most other cases. So that's the bearish case. There's some very smart people out there that are thinking along these lines, and that's the beauty of the market. You can often have market geniuses be in complete disagreement with each other. That's really the beauty of the market. Now let's get into the details of why that type of big breakdown is a very low probability event in our eyes. Now, before we get into that, don't forget to click on the like button on this video. It takes a couple of seconds. It really helps push out our videos to more people. It helps us grow as a channel, grow as a business, so it is really appreciated. And subscribe to the channel if you haven't already. And by the way, there's only 2 days left before the new website is live. 2 days to go, and also 2 days left for you to get a discount, a 20% discount on the membership. We don't do these kinds of discounts very often because the price of the membership is already very cheap. But for the 2-year anniversary and the launch of the website, we are doing a discount for the last people who sign up to the old website. So make sure to not miss this chance. Okay, so back to the video. We discussed the bearish case that a lot of people are talking about, that we're in the midst of a larger move down in the market, a move down to 3,000 points, what you'd be looking for the end of this bear market. And that could very well happen. Anything can happen in the market. As I said earlier, a lot of very smart people think that this is the direction we're heading in. And the only thing I can say is that we have a different opinion to that. And let me show you why. Let's go back to what is driving this market lower. What's been the pure driver of market price action throughout this period? We have to put up the 10-year yield, the 10-year government bond yield. And here I'm putting the inverse of the 10-year yield so that you can actually see that relationship. This is something we've discussed many times before. And you can see right here, we have the driver of market price action for you right there. It's the 10-year yield. It's the bond market, right? So a great representation of what the market is anticipating Fed rate hikes to be. And just think about that, right? This is the inverse of the 10-year. As this is going down, 10-year is going up. That means over time, right, since the month of July, you can see on the left-hand side, the 10-year yield went up throughout this period 1.5%. So of course, this is the discount rate rising that's pulling the market down. Because if you can get a better yield on bonds, why would you be buying stocks that can go bankrupt? The yield on the government bond is the government paying you back. So as long as the government is still there, you know that you're going to get paid back. So valuations are contracting here as a result of that. So in order to see a market collapse here, you'd basically need to see yields go completely parabolic here and, cover a lot of ground, perhaps go up another percent. If you see the 10-year yield in the next few days go up to 5-6%, you're probably seeing a market collapse because of that. But as I'm about to show you, we don't think that's very likely. Now, you can see here, if we're talking about the short-term technicals, you can see we have a little bit of divergence there with the market again trying to kind of time this bottom here in yield, right? You can see yields are moving down and the market is going up. This, I'm very skeptical of, because we've seen stocks try to do that multiple times and fail every time that, yields don't confirm that move. This painful bear market rally was a very good example of that yields were basically saying, nope, we're going in the other direction. You have to sell here. So perhaps we're seeing a mini version of that in the short term that could pull the market down in the near term. The durable bottom that we had in June, you can see we actually saw yields bottom first, yields topped first and then the market bottom. It doesn't have to happen in the same way. Stocks could anticipate the bottom, but nevertheless, you have to be a little bit more skeptical of this type of setup. Let's actually go on the chart of yields to understand what is going on here. So this is the chart of the 10-year bond yield, so not inverse. And you can see it has been going up here, going up, going up. And so going back to what I was saying earlier, in order to see a market collapse, what would you need to see? You would need to see this type of thing. You'd need to see basically a parabolic, an acceleration of yields to the upside that goes up to 5.36%, a massive collapse in the bond market, a massive rise in bond yields, and that could trigger a big move down in the market. So, that's possible. Anything can happen in macro. If you have a big news event that drives that kind of move, that could happen, right? And that's the bearish case. If you're bearish on the market, that's essentially what you're betting on. Now, we could also have a collapse in earnings. That really doesn't look like it's going to happen imminently, but that's a whole other story. In the near term, the market is being driven by rates, the 10-year yields, and you can see if we look at the technicals here, this is a momentum indicator, the RSI, and we are seeing a slowdown in momentum. Take this for what it is. Its technicals can be an incredibly powerful tool, but they can also be very misleading. But textbook technical analysis tells us that when you have a higher high on the price and you see this type of move on the RSI, it's telling you the momentum of that move is fading and you're probably going to see a break, a counter trend move following this type of development, not an acceleration. And this is what we got here, where we had rising yields, momentum was slowing, and then we had a correction. Again here, rising yields, momentum slowing, and you have a correction. I can show you again here, rising yields, momentum slowing, and you have a correction. Now, we also discussed where rates are headed. So the 10-year yield, where we think it's going to be heading. It's really a very in-depth article that goes through all the driving factors of rates. It builds a model to predict bond yields. We really throw our entire view of the current bond yield situation in this article. If you understand this research, you basically understand today's market and what kind of price action you can expect in the 6 to 12 month time horizon. Of course, that is just my opinion. Now, that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, don't forget to smash that like button and click on that subscribe button if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.